Welcome to this explainer. Today, we're diving straight into a massive paradox surrounding Robinhood stock right now in 2026. If you own Hood, or even if it's just sitting on your watch list, you're going to want to pay very close attention to what we're breaking down. We're looking at a company where the numbers are somehow telling two completely different, absolutely wild stories at the exact same time.
So the million-dollar question we have to answer is whether Robinhood is a buy, a sell, or a hold. Because right now, Wall Street is practically pounding the table saying buy, while at the very same moment, company insiders are cashing out their shares at an aggressive pace. It sets up this fascinating clash of perspectives that we really need to unpack, piece by piece, to figure out what's actually going on beneath the surface.
Here's how we're going to break it all down. First, we'll look at the Robinhood paradox, move right into the bull case, and then flip to the bear case. After that, we'll dig into the tokenization gamble and wrap it all up with our final verdict.
All right, kicking things off with Section 1, the Robinhood paradox, where we've got two completely different stories playing out.
Just look at this tension. On one hand, you've got unanimous praise from Wall Street. I'm talking 22 buy ratings and a massive 120 average price target. But flip the coin, and on the exact same timeline, the insiders running the show, they've aggressively cashed out to the tune of a staggering $1.2 billion in the past year. Talk about a divergence. This definitely demands a closer look.
Let's move into Section 2, the bull case. The growth machine. Let's look strictly at the numbers to see why analysts are so incredibly bullish right now.
The Q2 2026 numbers show us very clearly that this is no longer just a scrappy startup. Look at these figures. $1.31 billion in revenue, which is up a super impressive 32.5% year over year. Earnings per share hit 62 cents, cleanly beating expectations. But honestly, the most jaw-dropping metric here is that 42% net margin. Robinhood has quietly transformed into a highly profitable financial super app. And they aren't stopping there. They've expanded aggressively into futures and derivatives by acquiring MIAX, and they've pushed the tech boundaries by launching their very own Layer 2 blockchain, the Robinhood chain.
What's really fascinating is the sheer velocity of this growth. We're looking at an incredible 800% year-to-date explosion in on-chain equity volume. They started the year relatively quiet and have absolutely rocketed to a massive $9 billion in volume. If this trend holds up, Robinhood is perfectly positioning itself to be the backbone of decentralized finance for everyday retail investors.
With an infrastructure play like that, combined with those stellar profit margins, it's really no wonder Wall Street is all in. 0 sell ratings. None. 22 analysts are screaming buy, and 5 are saying hold. With that $120 average price target, analysts are projecting a massive 26% upside from current levels. On paper, looking at these growth metrics alone, it feels like an absolute no-brainer. But you know how it goes in finance. Growth is only half the story. Let's flip to Section 3, the bear case, focusing on valuation and insider selling.
It all comes down to the price tag. Right now, Robinhood is trading at a price-to-earnings ratio of 53. To put that into perspective, legacy heavyweights like Charles Schwab are sitting down at an 18 PE, and Interactive Brokers is at 20. You are paying a massive, massive premium for Robinhood's growth story. You really have to ask yourself, is there potential in blockchain and futures actually worth paying more than double the multiple of established brokerage giants?
Because of that huge premium, analysis platforms like GuruFocus actually flag the stock as being overvalued by about 23%. They peg the actual fair value way down around $78. Plus, we're seeing intense technical pressure right now. The stock's down 17% year to date. And the take-or-buy-sell ratio is hovering at 0.60, meaning sellers are firmly in the driver's seat for short-term price action. They're currently testing support at $92, and if that floor caves, we could drop straight down to $86. And then there's this number. I mentioned it earlier, but we really need to let it sink in. $1.2 billion. That is exactly how much stock insiders have dumped over the past year. During that exact same time frame, they've only bought a meager $55 million worth. That is a 22-to-1 ratio of selling versus buying from the folks actually steering the ship.
And look, it's not just mid-level execs taking a little off the top to buy a boat. Key figures are leading the charge. Co-founder Baiju Bhatt recently cashed out an additional 50,000 shares for nearly $5 million. Now, sure, people sell for taxes or diversification, we get that. But when founders are cashing out at these elevated levels while simultaneously projecting extreme public optimism, well, you can't help but raise an eyebrow, right?
Which brings us to Section 4, the tokenization gamble. The CEO's big bet. and the wildcard X factor that could either justify that sky-high valuation or totally blow it up. CEO Vlad Tenev has been on a relentless media bliss, pushing what he calls the tokenization supercycle. It's a huge concept, the idea that eventually every single traditional asset out there, every stock, bond, and commodity will be traded and settled on-chain. And Robinhood doesn't just want to participate, they are aggressively positioning themselves to be the foundational infrastructure provider, the ultimate gateway to this new decentralized world.
Just listen to this bold quote from Tenev. We believe within 5 years, most assets will be traded and settled on-chain. He's putting a strict 5-year clock on a fundamental rewiring of global finance. If he's right, Robinhood isn't just a retail broker anymore. It becomes an entirely new class of financial infrastructure. And honestly, that absolutely could justify a much higher multiple than Charles Schwab. But here's where the paradox hits you over the head again. They are betting the entire farm on this blockchain gateway future, but if you look at their current reality, their actual core crypto trading volume literally plummeted 62% in July. Regulatory clouds are still this massive, unpredictable wildcard. So you have a company banking its entire future on a blockchain revolution, while ironically, its actual crypto business is shrinking right now. So let's bring it all home in Section 5, the final verdict. What is the actual actionable takeaway for you? It really boils down to your personal playbook. If you're a growth investor with a high tolerance for risk, you're probably seeing massive asymmetric upside here. If that whole tokenization thesis pans out, grabbing shares now might actually look cheap, and that $120 target might even be conservative. On the flip side, if you're a value investor who plays it safer, you're staring down an incredibly expensive multiple loaded with regulatory risk. Your move is probably to sit tight and wait for a pullback into that much safer $70 to $80 fair value zone. But no matter which camp you fall into, keep your eyes glued to that $92 support level on the charts. If you see the stock hold and bounce there, especially if it's combined with some positive regulatory news in crypto, that could be the exact technical buy signal you're looking for to confidently jump in. Which leaves us with the ultimate question as we wrap up this explainer. Based on all these competing realities, are you looking at a generational opportunity to buy into the future of finance, or is it totally overhyped and overpriced? It's a high-stakes gamble, for sure. Hopefully, this breakdown gives you the clarity you need to navigate it. Thanks so much for tuning in, and definitely keep a close watch on those charts.